Hello, I'm Wade McElwain, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. The major debate among investors in 2020 has been about growth versus value, and whether or not growth had finished off value for good. Within that debate, however, are a number of very important subplots. One of those is the future of dividends and dividend investing. After all, growth stocks are largely focused on, growing. And the money that they generate is often reinvested back into the business to boost the top line, rather than rewarding shareholders through the payment of dividends. Shareholders seem to have accepted this by and large, perhaps in part because of the stellar rise in share prices that growth stocks have enjoyed in recent times. The 10-year average return of the Nasdaq is almost 14.4% per annum. Share prices have also been helped by share buybacks. And though many of those have been put on ice during the pandemic, research from Goldman Sachs in 2019 found that buybacks were the dominant source of stock market demand, and that U.S. companies spent $480 billion buying their own shares back during 2019. However, capital growth hasn't always been the main driver of stock market return. It's estimated that some 78% of the total return in the S&P 500 came in the form of dividends and their reinvestment. That's a figure large enough to make most of us sit up and take notice. So what's the future for dividend investing? Actually, it's potentially quite bright, and for two reasons. Firstly, with interest rates at or near zero, income is an increasingly scarce commodity. That means investors looking for regular, reliable returns are increasingly focusing on quality dividend stocks. Stocks, for instance, like the Dividend Aristocrats, companies with a track record of at least 25 years or more of dividend growth. In fact, there are 10 stocks among the aristocrats with a 50-year history of continual dividend growth. Secondly, receiving and reinvesting dividends is a great way to grow your portfolio. Owning quality stocks that reward you for holding them and then pumping that money back into the market allows you to compound your growth. In a way, by reinvesting your dividend income, you're playing the growth stocks at their own game, and potentially in more ways than one. The Dividend Aristocrats form the basis for the S&P 500 Dividend Aristocrats Etf, ticker NOBL. And over the last 6 months, its price has risen by 24.35%. That compares very favorably with the 28.67% return generated by the growth-oriented Nasdaq Composite Index over this same time frame. According to Trackstar IQ, our proprietary search tracking tool, 5 institutional Wall Street investors have been tracking NOBL recently. Currently, the S&P 500 index dividend yield is estimated to be just 1.6%, its lowest level since December 2004. Of course, many businesses have been conserving resources in 2020. In the case of the banking sector, the major players have been prohibited from making payouts to shareholders completely. That won't always be the case, though, and there's a real chance that those bank dividends may have not been forgone, but merely deferred for a future date. Sometimes it can pay to follow a strategy that's not considered sexy and doesn't get all the headlines, but brings home the bacon. Dividend investing may just be a strategy that's perfectly suited for the reopening of the economy next year. That's all we have for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.